Hi there, it's Alvin from Dr. Wealth. The S&P 500 has been creeping up since October last year till February. The S&P 500 index is up 15% already. So some people still think that this is a dead cat bounce and eventually the market will fall back again and causes more losses in the markets for a lot of investors. And the other camp believes that this is the start of the bull run and the worst is over. So who is right? So watch till the end of the video and I'll give you my views. And let's talk about yesterday. There was a very important development. That is that the Federal Reserve has raised the interest rate, nothing new here, but just by 0.25%. It has been always at 0.75%. So you can see that the Federal Reserve has slowed down the rate hikes. And this is actually expected because markets have already been pricing in this slower rate hikes since a few months ago. And that could possibly be one of the reasons why the S&P 500 has been going up. But this is still a very major development, a big milestone, because rate hikes have moved on to the next phase and likely, in my view, is going to top out around 5% max this year, and I'll give you the bullish case on this subsequently. And with this rate hike confirmed at 0.25%, the S&P 500 actually rallied near the end of the trading session, up another 1% yesterday, and Nasdaq was up 2%. So it is kind of a bullish news, and even year to date, the S&P 500 has been up 8%, just a month, and it's up 8%. So it's one of the strongest start to a year for the US stock market. Of course, there are experts who are bearish about the stock market. One of them is Michael Burry. You would have known this name if you have watched The Big Short, okay, where it is about the 2008 financial crisis, where his fund went in very aggressively to bet on the downside, to bet on a crash in the financial markets, and he was right, and he made a hell of money from that. He became one of the well-watched investors, and everyone is very curious what he thinks about the market. So Michael Burry has been very bearish since like 1-2 years ago, right? It's not something new. And yesterday he tweeted sell, okay, just a word sell. He didn't really elaborate, but it is a continuation of what he have done last year. Quarter 2 2022, he actually sold majority of his stock holdings. So he does walk his talk, and he was pretty much out of the market. And he believed that this is a dead cat bounce, and the bigger and deeper crash is going to come eventually. He didn't say when, right? Probably he doesn't know when, but good inkling that the bear has not been defeated yet. Okay, so it is not time to rejoice, and this is like a trap for the bulls. And another bearish person would be Nassim Taleb. You might have read his book, The Black Swan, and he used the term called Disneyland. Okay, so Disneyland is like fantasy land, it's not real, and he used it to depict what investors have been living through in the past 15 years, where interest rate has been kept very, very low, close to zero, and the market has been rallying. A lot of risky assets have gone up in prices. Maybe people forgot about risk. He thinks that now is the new normal with higher interest rates is unlikely to get cut. And he believed that the next 15 years is going to be tough for investors. It's not going to be as easy as what has happened in the past 15 years. So this is another longer term bear case from Nassim Taleb. And another investor that was bearish is this guy called Mark Spitznell. Okay, it's quite hard to pronounce his name actually. And his fund, Universa, is actually advised by Nassim Taleb. So his fund is very unique. It's like a hedge against a downturn. It's a hedge against a market crash, a black swan event. So it always buy a lot of those kind of put options. And if the market crash, you make a lot of money. So they sell this fund as a hedge, like an insurance that people buy to protect the portfolio from a major crisis. So he, of course, is always on the bearish side because that's how his funds make money. And he believed that a crash that's as bad as the 1920s Great Depression is going to happen. Okay, so with all these bearish cases, it's quite hard to go against this expert because we believe that they know more than us. They are inside the market, they're insiders, they are a lot more intelligent and smarter than us. But I also want to give you a counter argument, give you some statistics why it could be a bull run. Okay, so the first point that I want to talk about is that in a video that I've done in November last year, where the US was undergoing a midterm election, I was sharing the statistics and saying that after the midterms, usually the stock market is very bullish, and that's represented by the S&P 500. And just to recap what I shared in the video, I took the stats from US Bank Research, and what they found is that the S&P 500 after midterms, 3 months after the midterms itself, you have about 7% gain. 6 months after you have 15% gain. 12 months after you have 16% gain. And not only that, the 6 months to 12 months after the midterms have always been a positive return. So with these statistics, I was sharing that it should not be that bearish in 2023, and so far it's sort of like worked out. I don't have any magic number, I'm just looking at the probability, right? Which means that now we are about 3 months from the midterm election, and since it's bullish to up to a year, we could see a majority part of 2023 S&P 500 may continue to stay in a positive territory. So that is one statistics. And another one is this video that I've done in October, 1 month earlier than the midterm election video. And even though it was October 2022, people were already talking about potential recession. And that was like the talk of the town. Everyone is worried. And eventually, a lot of the firing in the tech companies happened in the ensuing months. And I did say that recession is actually not something to be fearful about. It has no correlation with the stock market performance actually. It's about half of the time when the economy is in recession, the market is down. The other half of the time during recession, the market is up. So there is no correlation. It's as good as a coin flip. But what's interesting is what happens after a recession. So this is a table I actually shared in the video, right? So let me just blow it up for you to see. And you can see that the performances after a recession usually is very, very bullish, right? 1 year, 3 year, 5 year, 10 years later, after a recession, you can see that the performance of S&P 500 has been very, very positive, double-digit kind of returns. So actually, recession is not something to be feared. It's actually a bottom indicator. And if let's say recession really happened this year, which most people think that it's going to happen, and personally I also didn't think so, right? Because of the yield curve inversion has already happened for quite a while. This year looks like a ripe year for recession. So if it indeed happens in this year is actually a good year to buy stocks and not a year to avoid stocks altogether. And the other stats, and the third stats I want to share with you is that we all know most of the time the stock market is a bull run. And this chart itself, what it's trying to say at the end of the day is that if we just look at the rolling 1 year performance of S&P 500, more than 80% of the time S&P 500 is positive, right? So you have some mathematical numbers for you. And if last year S&P 500 has been negative, this year the chances of S&P 500 being positive is a lot higher, right? Because most of the time, as we can see, 80% of the time, S&P 500 is delivering a positive return in a year. So that's why I think that it doesn't make a lot of sense to always be on a bear camp, especially if your investment horizon is long. You do want to stay in the market most of the time, right? I'm not saying that you can't sell before a crash, but that involves good timing, and not everyone are able to do that timing well. Okay? So that is something that you should consider. And using this statistic, it shows that most of the time you should be invested one way or another in order for you to reap majority of the returns. Otherwise, you might miss out some of the gains in certain years. Okay, so that is the importance of understanding these statistics. And a little bit of technical analysis that I want to share with you here. This is S&P 500. You can see that it has been downtrending since the start of 2022, and there is this mother of all trend line, the blue down sloping line, as you can see in the chart. And every time the S&P 500 touches this trend line, it reverses. It goes down lower and form a lower low, right? Interestingly, what happened was that since October onwards, they were a lower high, not just a lower low, and they were testing this downward sloping trend line a lot more frequently. And finally, in early 2023, we can see it actually broke out of this downtrending trend line. So that is a bullish sign, and now it's also trading above this 200-day moving average indicated by the red line. So from a technical perspective, this is actually a bullish setup. I just want to give you another counter argument and what my observation about the markets are at this moment. So I do think that the market is still more on the bullish side rather than on the bearish side, okay? And another market observation is this. This is the yield curve, latest yield curve of the US interest rate. And we can see that the peak interest rate indicated by the market right now is at 4.8% at the 6 months tenure. Okay, so how we can interpret this is that it is likely the Federal Reserve will still raise interest rate, okay, 3 months from now, 6 months from now, right? So likely 2 more rate hikes, but it's unlikely to go above 5%. You can see it's about 4.8% at this point in time. And in fact, they expect thereafter the Federal Reserve would cut rates, okay, to stimulate the economy. Maybe there is going to be a recession, right? We will not know until it really happens. Even the yield curve is suggesting that it's just 2 more rate hikes, and probably the Federal Reserve is pretty much done. As I said, recession has no bearing on the stock market performance. It's only after the recession, stock market is very bullish, right? During the recession, the stock market is neither here nor there. And but if there is an interest rate cut, it is generally a very bullish kind of a signal. So that is why with all these statistics and the market indication, I do think that the bull run has a lot more legs to run, even from this point in time. Ultimately, nobody has a crystal ball, okay? So yes, everyone can share their views. I can share my view. The experts can share their views on Bloomberg, on CNBC, on the major media outlets. But I think at the end of the day, it's very important to consider our own situation, right? Especially if you have capital lying around and you don't need them and you can afford to invest for a longer horizon, you do not really need to time the market. You don't really need to know, oh, is the market crashing? When is it going to turn? It is a lot of work, and there is also a risk of mistiming. So I do think that for majority of the people, staying in the market for majority of the time makes more sense, because most of the time the market is in a bull run. Okay, there is a very high tendency for that to happen. And if you sit on the market too long, you will miss a lot of gains from that. I hope the sharing has been useful. I share with you my view. I'm more on the bullish side, but depends on your situation, depends on investment objective, depends on the availability of capital. You have to decide for yourself. Okay, don't just take my word for it, and don't take anyone's word for it. You have to make your own call. It's your own money. So I hope you like the video. Give me a thumbs up and subscribe to the channel. I'll see you in the next video. Goodbye.